Hello everyone, welcome back to my channel Commerce Diaries. I hope you all are doing well. In the today's video, we are going to learn an important concept of our accounting syllabus, that is the accounting concepts. Okay, so let us begin with this video. Accounting concept means the assumptions or the conditions on which the whole accounting structure stands. They are predetermined conditions which bookkeeper must keep in mind while recording the transaction in a books of account. So accounting concepts are basically certain assumptions and the conditions which we followed when we run our business or we practice our business activity into the day to day life. Okay, these are the certain kind of the conditions which we have to follow for the smooth functioning of our business, as well as a certain a profit and shows the true and fair view of our business. So let us begin with the each and every concept one by one. So the first concept is business entity concept. This concept is also known as the accounting entity concept. This is an important point over here. This concept requires the business and the person who control and own the business are the two different entities. So business entity concept, in this concept we treat a person that is the owner of the business. He is different from his business. So the any activity which are conducted by the businessman in his personal life, we will treat them as a separate apart from the business. Further, an accounting entity is regarded as a separate and a distinct from the owner. Due to this concept, owner and his business are considered to be a separate. So as we have discussed, the business is the separate activity and businessman doing any kind of activity in his personal life, any activities apart from the business, they both are a separate things. We will record them in the separate. Okay, all the transactions of the business are recorded in the point of view of the business. Personal activities of the owner not recorded in the accounting books. Okay, so let's see the example. Mr. A purchased a household purpose will not recorded in the business account. Means any businessman, if he purchases any kind of things, for example furniture, any machinery, electronic items, or any expenditure he occurred in his personal life, we will not treat them in his business books of account. We will treat them a separate apart from the business activity. So the business entity concept shows that the businessman and the business, they both are the separate entities according to our accounting point of view. The next concept, that is the money measurement concept. This concept stated that only those facts which will be recorded in the accounts which can be expressed in terms of money, if the facts are not measured in terms of money, then such fact we will not record it in the books of account. Okay, as the name given, money measurement concept, we will record it only the monetary items in our books of accounts of our business. Non-monetary transactions or non-monetary activity we will not record it in the books of account. Money is a common denomination which all the transactions are measured for the purpose of recording in the books of account. If the different transactions are not expressed in terms of money, it will be meaningless to present in the transaction. So if any kind of the transactions are not defined in the monetary terms, so these kind of the transaction will be a totally meaningless or unnecessary to record in our books of account. Let's see the example. salary paid to the manager, we will record it in our books of account. So salary is a item which we can express in terms of money. So the salary paid to the manager or the employees, we will record it in our books of account. But the competence, it has no place in the books of account. For example, any eligibility or any kind of the good work of the employee, satisfaction of the employee, these are the non-monetary items, these kind of the things which we will not recorded in our books of account. So money measurement concept stated that we should record only monetary transaction in our books of accounts. The next concept, that is accounting period or periodicity concept. All the transactions are recorded in the books of account on the assumption that the profit on these transactions are certain for the specific period. Okay, see, if we are doing any kind of the business, as it's a continuous process, but we have to measure or we have to analysis of all our transaction into the particular period. So that period should be specifically given by our accounting terms, so that we will call as a accounting period. This is also known as a periodicity or the accounting period concept. Okay, thus this concept measures that the balance sheet and the profit and loss account should be prepared on the regular intervals. So this is the important point over here. Periodicity concept or the accounting period is important to ascertain the profit and loss of the business while doing all the business transactions. Then next, this is the necessary for the different purposes like a calculation of the profit, a certain of the financial position, tax, consumption, and the etc. Usually a 1 year is taken as an accounting period, which may be a calendar year or the financial year. Usually in the normal course of the business activities, we will assume a 1 year as our accounting period, but it is advisable that we should follow the financial year as our accounting year. Okay, for example, in the regular course of business, we treated a 1st April to 31st March as our financial year. Okay, so this concept shows that we should measure or we should examine our transaction in the particular time period that will be a accounting year or the financial year. Then next concept, that is the cost concept. As per the cost concept, the value of asset should be recorded at the acquisition and the purchase cost. In other word, that is the historical cost. Okay, so what this concept treat, like if we are purchasing any kind of the assets or any kind of the purchase in our business, that we will record it in it's the original cost or the cost at which we acquire those kind of the asset. These concepts required that the asset should be valued at the acquisition cost rather than the market value. Though the asset can be disclosed in the balance sheet at a different values such as a market value, realizable value, etc. It is the proper shows that the cost of valuing asset at a cost is a free from the biases. Okay, so when we will purchase the asset, we will record those assets in the original cost in our books of account. Then we will treat it whether the asset is getting realized or it is getting depreciated. Okay, then next, all other values involves and the element of the subjectivity in the valuation of the asset. Let us understand this concept with this example. If a plot of the land is purchased of rupees 1,50,000, then as per this concept, the asset will be recorded in our books of account 1,50,000 only. even if the market value at that time will be a 2 lakh, so the asset at cost we will record it at the purchase amount. Okay, so here, as per this concept, we will record it all our assets at we acquire them or we purchase them at the cost. Okay, even if the value of asset is getting appreciated or depreciated, we will treat them separately, but in our books of account we will record it all our asset at a cost, that means at a historical or the purchased cost. Okay, so next concept is that going concern concept. According to this concept, enterprise is normally viewed at a going concern. That means it is assumed that the enterprises we will continue their operation near or foreseeable future. Means, as we are knowing that a one time activity of any kind of the trading or one time activity of buying and selling, we will not treat it as a business activity. Okay, so according to this concept, we will run our business in the future succeeding years. Means, we assume it that our business will go for the longer period of the time. Then it is assumed that the enterprises has neither intention nor the necessarily of the liquidation. Okay, means we will not assume initially itself that we will liquidate our asset in the near future. Okay, it is also assumed that the enterprises will not materially curtail down its operation in the near future. While preparing the financial statement, it is assumed the business activity we will continue and there is no intention to close our business. Means when we will run our business, we ascertain our profit. At that time, we will not assume that this particular year I will do the business activity and another year I will stop those activities. No, we assume every time that my business will run for next succeeding year and goes on for the longer period of the time. This concept is the fundamental accounting assumption. This is one of important point over here, that the going concern concept is the concept of the fundamental accounting assumption. Okay, then let's see the next concept, that is the revenue recognition concept. This concept is also called as realization concept. This concept requires that the profit should be accounted only when it actually realized. Okay, so what revenue recognition concept stated that we will record it our revenues as and when it recognized in the real. This means the revenue or the profit should be recognized only when the sale is affected or the services is enhanced. Okay, so what here given is that the revenue assumed to be realized when it actually treated in our business. Revenue for the business transaction should be included in our accounts or in our business only when it is the realized. Okay, so let us see the example. Mr. A places an order with the Mr. B for the supply of the certain goods which are yet to be manufactured. On the receipt of the order, Mr. B purchased a raw material, employs worker, procedure of the goods and delivered finished goods to Mr. A. Mr. A makes the payment on the receipt of the goods in case the sale will be presumed to have been made and not at the time of the receipt in the order or the goods, but at the time the goods are delivered to Mr. A. According to this example, Mr. A places the order to the Mr. B. In this example, what Mr. A will do is that he will do the payment when the actual delivery of the goods is done. So the sale will be presumed have not been received at the time of the order, but it will get recorded when the actual delivery is made in this. Okay. The next concept, accrual concept. Okay. So this concept requires the revenue and the cost should be recognized as and when they earn or incurred, and not when the money is received or to be paid. In the other words, we should follow the mercantile system of the accounting and not a cash system of the accounting. As per this concept, we will recorded the credit transactions that we are expecting are inflow of the cash in the business. Okay, so we will not treat it this concept as a cash concept. No, we will recorded our transactions on the credit basis also. Okay, in the cash system of the accounting, revenue is recognized only when the cash receives and the expenses are recorded when the cash is paid. However, this concept requires that the income and expenditure should be recorded in the period which expenses belong and not the period which the expenses received, income received or the expenses are paid. Okay, means in our cash concept we recorded our transaction when the actual inflow of the cash and actual outflow of the cash are to be made. But in the accrual concept we will not wait for such inflows and outflow. We will record them when the transaction is done or when the activities are getting performed. The income is recorded only when it realized, that is, either it is received or earned. Revenue are recorded only when the sales are affected or receipts are rendered. The sales revenue are considered as recognized when the sales are affected during the accounting period, irrespective of the facts whether the cash is received or not. Okay. Now let us see the example. For example, a company invested rupees 1 lakh with the bank for a 1 year, that is the 1st October 2015. The bank has to pay at a 10% per annum on the maturity period of the 30th September 2016. So here we will understand that the accrual concept is recorded the transactions. It can be either on the credit basis or it may be on the cash basis. Okay, so this concept is important where we can record it our outstanding expenses and the prepaid expenses. We can make an adjustment on the basis of this accrual concept. The next, dual aspect concept. This concept is the core account of accountancy. It is also referred as the balance sheet equation concept. Okay, this is an important point here. According to this concept, every business transaction is recorded in the books of accounts has a two aspect. Okay, means as we are doing any kind of the adjustment in a balance sheet, it will shows the two effect over the in our balance sheet or in our accounting transaction. The twofold aspects are increase or decrease in the assets and the liabilities. Every transaction or the event has a two aspect, such one be a debit aspect and another be a credit aspect. Okay, so as we are following the double entry system, so each and every transaction will have a two kind of the effects in our accounting books. One can be a debit and another can be a credit. For example, suppose Mr. Rahul purchases a asset of rupees 1 lakh in a cash. In this business transaction, Mr. Rahul receives the asset of rupees 1 lakh, but on the other hand the cash balance will decreases of rupees 1 lakh. So the asset account and the cash account shall be affected with this transaction. Means if we are doing a one kind of the activity, it will automatically impact on the other activities of our business. In this example, Mr. Rahul purchases a asset, so his asset side is getting increased, but at the same time his cash balance is getting decreased as he purchased his asset by paying a cash. So this is a dual aspect concept. Then next, matching concept. In this concept, all the expenses matches with the revenue. That period should be taken into the consideration. The objective of running business is to earn the profit in order to ascertain the profit made by the business during the period. It is necessary that the revenue of the period should get matched at the cost and the expenses. So, according to the matching concept, we have to matches our revenue with our the expenses. We are doing any kind of the business activity in our succeeding year or in our particular financial year or the accounting period. At the end of the accounting period, we have to match our revenues with our expenses to ascertain a accurate profit, or it shows a true and fair financial position of our business. The term matching means the appropriate association to the related revenues and the expenses. Let's see the example over here. ABCD purchased a large application from the wholesaler of rupees 5,000 and resell it to the local restaurant worth rupees 8,000. At the end of the period, ABCD should match the 5,000 cost with this 8,000. Okay, so in this example, what ABCD Limited has done is that it has purchased the large application of the 5,000 and resell it to the 8,000. Okay, so here we will earn a profit. So ABCD Limited has to match his revenue with his expenses in the succeeding or in the going financial year. Then next, the last concept is full disclosure concept. As per this concept, all the significant information must be disclosed. Accounting data should be properly classified, summarized, and aggregated and explained for the purpose of presenting the financial statement, which are useful for the user of accounting information. Full disclosure concept stated that we have to disclose all the material facts, all the relevant facts to the general public or to the stakeholders which where they are interested to doing our business activity in the future, which shows our true financial position to the stakeholders. This principle emphasizes on the materiality, objectivity, and consistency of the accounting data, which should be disclosed the true and fair view of the state of this affairs of the firm. Okay. For example, disclosure of the financial statement by the companies in the respected business journal. As we know about that, many recognized companies or many recognized financial institution or the banking institution disclose their accounting statements in the business journal so that the stakeholders will get the idea about the financial position of that particular institution, so whether they will decided whether we have to do the business with those institution or not. So this was all about the concepts of accounting. If you like this video, if you find this video helpful for your preparation and if it simplifies your concepts, so don't forget to like this video and subscribe to my channel. We will meet in the next video. Till then, have a nice day. Thank you.